What's driving the big rally in precious metals prices, and is it set to continue? Today, we're joined by two experts in the field, Jaime Carrasco from Harbourfront Wealth Management and Dan Wilton. He's the CEO of First Mining Gold. Both of them have decades of experience in the precious metal sector and analyzing precious metal mining stocks. Dan and Jaime, welcome to Ron's Basement.
Thank you for having me again.
Thanks, Ron. It's a pleasure to be back in the basement.
Yeah, well, this is going to be a great conversation. I thought we would start talking about kind of the macro factors that are affecting the gold and silver prices, and then narrow it down and talk about what's going on. Is the smart money right now taking a look at the precious metal mining stock? So whoever wants to kick us off, what's behind this big move that we're seeing in gold and silver over the last 6 months to a year?
Well, let me start on this, more on the macro, because I don't know how smart the money is right now, considering that 99% of Western wealth is still sitting on outside of the sector. That is the best hedge throughout history for the times and periods that we're going through. I think it's not being very smart right now. The 1% that are in like us, at first we were seen as crazy. But now we're actually looking at the benefit of being down the yellow brick road, as the old allegory goes, especially wearing silver slippers as we move down this. Again, when I look at precious metals, I am not a gold bug. I am a bond bear. I started my years in the practice being taught the bond market by the last generation of bond traders who have worked under a gold standard, where gold was traded ahead of US dollars, ahead of every currency on the bond desk. And that's something that was, smacked into the back of my head by my old mentors at the bond desk. And I think that's the big issue. People have to be looking at what's going on with interest rate, because the 80s are replaying, but nobody has noticed yet. And what's important there is to look at the fact that on the same day that the long 30-year treasury hit 0.74, talking about below 1%, 0.74, gold hit that temporary low in 2020 or whenever it was at 1450. Since then, and now we're looking back at 0.74, oh my, how low that was, even though we just crossed 5%. But think about this, 0.74, the first double gets us to 1.4, 1.5. Next double, 3%. We're heading for the third double, and people haven't yet figured out that this is about interest rates rising, about credit destroying itself. And gold is money, all else is credit for 4,000 years. Well, here you go. Now we're sitting at $3,300 gold, and yields have just crossed 5%. I think they're going to continue rising. Maybe by the time we get to the next double at 10%, they'll notice that gold is rising, but it's going to cost a lot more in Canadian dollars, 4,700. Now, why is that important? Because I think 10% is just on the way to wherever we're going. I say that simply because in the 1980s, to undo the debt bubble that we had then, rates had to go up to 18%. We're only at 5%. And this time we have exponentially more debts than we did then. So how high do we go? I don't know. But I'm very happy watching this whole show from the vantage point of the yellow brick road, because all of our holdings are doing well. Those companies that we were adding like crazy people over the last 3 years, well, they're just starting to build. When do I take profits? I think we have a long way to go. I'm more invested in silver. I'm one of the, not only am I in the 1% that is in the sector, but I'm also overweighing silver. Why? Because of the gold-silver ratio. The gold-silver ratio is set by nature, not by some banker's whim of where the price should be. And that banker's whim of where the price should be is based on credit. And that credit is getting more and more expensive to maintain the price mechanism. And so I've always said that when silver finally unpegs, it'll be the signal that they're losing control of the credit cycle. And that's what's happening. That's why silver is finally unpegging. So let's talk about silver for a second. The gold-silver ratio, which is set by nature, is the amount of silver that we pull out of the ground for every ton of ore that we pull out. 1 to 15, 16. Keith Neumeyer at First Majestic, that we all know, says about 7 to 1. Let's keep it about 20 to 1. Well, that means that the price of silver got down to 100 to 1. That was the opportunity. And that's why I was adding not only physical silver, but also the producers that are coming behind, because I think that's the biggest wealth transfer that we have seen for a generation. And those that have been able to take advantage and are getting prepared properly are going to do very well. Now, let's talk about this for a second, because one of the things that I'm looking at is you got all of these technical guys saying, worrying about price. I keep saying, forget about price, worry about your allocation. How much of a percentage in relation to your net worth are you allocated in the sector to protect from the destruction of purchasing power loss? One of the problems I see is that finally people are starting to notice, wait a minute, gold's going up, but you know what? The market's still at 42,000, right? So why am I going to worry? Well, the problem with interest rates is like boiling frogs. By the time the water gets too hot, it's too late. Well, I would say that 5% and what it's doing to the housing sector, what it's doing to everything, it's already a bit too late for people to start preparing. But by the same token, the cost of the hedges is getting more expensive. It's funny, I just posted this morning because this morning my last silver squeeze came. I've been buying the same amount of dollar-wise every month to put away into silver for a number of years since my years at Scotiabank. And and it's funny because I realized how little it's buying because I happen to have received some Scotiabank rounds. Scotiabank hasn't been a bullion bank for a couple of years. They stopped making those rounds a number of years ago. So what it meant was that somebody had sold that round to somebody at the mint, and then it came to me. But then all of a sudden I realized, wait a minute, this is nothing in relation to what I was buying a couple of years ago. Why? Because silver in Canadian dollars is at almost 46 bucks, $47. When I was buying it, it was at about $10 to $15. So the price is going higher. It's not that the price is going higher, guys. It's that the Canadian dollar is losing value. When I was doing that, we were at par. So an ounce of gold, if we were still at par, would be 3,300. Well, an ounce of gold now is 4,700. That's a big ticket item for 1 ounce. On the same token, a couple of weeks ago, we could buy 100 ounces of silver for that amount. Now it's starting to come back because the gold-silver ratio is going down. So bottom line is the hedges are getting more expensive. The frogs haven't noticed yet that the water's boiling. But when they finally do, are they going to be able to afford anything? I keep saying, look at silver, look at the producers. They're still cheap, but they're going to move fast. And gold is going to get more expensive. Now, the real question is, when do I take profits? When things return to some level of equilibrium. When the gold-silver ratio returns to some level of equilibrium, I will move out of my silver companies. But I think we're far from it. I'm not going to worry about what the technical guys are saying in terms of in and out, because what has that achieved? 99% of the money is still worried about price instead of allocation. I'm going to keep watching this show from the silver, from the vantage point of the yellow brick road, holding on to my silver. I'm open for questions, boys.
Go ahead, Dan. Dan, do you have any thoughts on what you're seeing? I'd like to thank the sponsor of this video, First Mint. They're a silver mint located in Las Vegas, Nevada, creating world-class silver bullion products. As a matter of fact, here's a 5-ounce silver bar. You can check this out for yourself on their website, firstmint.com. Couple of things unique about First Mint. They're owned by First Majestic Silver, headed up by Keith Neumeyer. So they're getting the silver out of the ground to the mint to you, from the mine to the mint. Again, you can check them out at firstmint.com. Thank you to First Mint for sponsoring Ron's Basement and sponsoring this video.
Yeah, and from a macro perspective, I think Jaime articulates it incredibly well. I tend to look at it over cycles. And we've always talked about this, and Jaime and I have talked about this in the past. Like, I kind of think of where are we in a cycle and what can we expect in terms of kind of a trough to peak rally? And just go back and look in history. The trough to peak really in the last cycle, which was in the 2000s, ending in 2011, would have been $260 an ounce to $1,900 an ounce. Right? Like you're
talking silver.
No, this is gold.
Okay.
This is gold. Yeah. So, you're more than 6x from the trough to the peak. this gold rally, let's say generously that we'll track this, market back to 2015, when you had the gold price down to around 1,050, something like that for a brief period of time. We've had a couple of rallies up, but nothing like this breakout that we've seen this year. So we're now, let's say we're 3 and a bit X up on the real, trough to peak. Is there any reason why we can't see another, 3 or 4X in the gold price in the not too distant future, right? Like, I think when you look at at that last gold rally, you also see how fast it accelerates in that last stage. Yeah. So, but the only way that you really benefit from that is being into it early, right? Like, you have to have been in the game. And that's where I think Jaime makes some really interesting points about, it's an allocation game here pretty soon. Like, if you don't have it, it's going to become very difficult to get.
Unobtainable.
Unobtainium. Yeah, exactly.
Yeah.
But I think that's where, particularly with silver, gold always has, there is a supply of gold. There's an annual supply of gold, but every ounce of gold that's ever been made is by and large, it's not consumed in the same way that silver is as an industrial mineral to the same degree. And that's where, I think, and spent a lot of time with our friend, Mr. Neumeyer, and talking about supply demand of silver, just the fundamentals where you've got this real supply deficit that's coming in silver, I think it's where, the difference is, I think in gold, you're competing against different people for the same thing, which is they're holding it as an investment allocation largely, and they'll sell it to you if people's views on that change. If you're buying silver to put in electric vehicles or iPhones, like, you don't have an alternative to that right now, and you're not going to have an alternative to it at any time soon. So that's where I think that supply crunch, when it really hits and it feels like it might be starting, that's where you see this gold silver ratio move from 100, which in my career is, I've been doing this for 30 years. I can't really remember 100 gold silver ratio before. Like, that's got to be several standard deviations away from the mean. But you can see it push to 20, right? And that's where, if you think the gold price is going up, and I do, and you think that the gold silver ratio is going to adjust and potentially overcorrect due to the relative scarcity of the metal, and that industrial nature of silver really contributes to that, I think silver could be very, very well poised for, the kind of panic buying explosive returns.
Let me add some points, because you made some really good points on the historical aspect of this. And one of the things that I keep saying is, personally, I don't think I'm going to take any profits off the table on my silver until we see at least a 40-to-1 silver ratio, which is still very conservative as to where we're going. That's the first point. Second point that we have to understand is that, I've been calling this move in gold and silver for a long time, only based on the fact that if you look at history, we are at the end of a monetary system, which I think is becoming pretty clear that we are going back to an asset, back to away from the fiat system and back to sound money, because it's the only way that they can repay debts. It's to devalue them. Scott Bessent already said that they wanna adjust the asset side of the ledger. Well, there's only one thing on the asset side of any government's ledger, and they've been buying it like crazy. Most people haven't noticed, but central banks have been buying gold like crazy for the last couple of years, and they're taking it away. So why is that important? Because by the time silver gets to the 40-to-1 gold silver ratio, where's gold going to be if we are heading for an adjustment on the asset side of the ledger? So that's why I'm not touching anything. I think the win is clear. Are our backs to those that have already built those allocations. I'm going to have a massive fight with compliance, because the value of those allocations is going to get bigger and bigger and bigger as a percentage of the portfolio, and I don't want to adjust the size as it grows, because that's a wealth transfer. But where are we going is the question, right? Like, if you do the math and you look at Judy Shelton, which most people don't know who she is, but she's an important player in this because She was the person that Trump nominated to replace Janet Yellen when she stepped down and Powell steps in. Well, her proposal is to do a $5 trillion 30-year bond backed by the U.S. gold reserves, which is in a way exactly what Roosevelt does in 1933 to reset a brand new pool of money. If you do the math, though, we're looking at about $20,000 gold, right? To achieve that devaluation of the fiat system. So between just crossing 3,300 and 20,000, there's plenty of room to benefit from what I've been saying all along, that when I look at my holdings in the sector, I have some that have already been taken away, like Mag Silver just got bought out. There's been a number of buyouts, but I look at, for example, something like an Agnico Eagle, like a longboard of a wave that we can ride for a long time. Some of the smaller ones are going to get taken out along the way, but I'm going to manage my position to be able to benefit from that wealth transfer, because all we're witnessing is these trillions and trillions of dollars that are sitting in the fiat system. Well, in order to rebuild the monetary system, we have to take all the value of that and transfer it back to a sound money system. And the value shift that always occurs, as it did in 33, as it has occurred throughout history, it's always the same replay. But that creates massive opportunities, and the biggest one is in the miners. Now, one last point that I want to make here, that both Egon Van Gruyers of Gold Money had made, and the same point that Rick Rule had made. One was looking at it from the asset side of the equation, the other one from the dividend side of the equation. And this is interesting because this is a repeatable pattern that also happened in 1933. In 1933, before the beginning of the shift, if you had $10,000 invested in homestake mining, by the end of Bretton Woods, by the time that Bretton Woods get placed, which was almost 18 years, that $10,000 turned into $100,000, paying you $10,000 in dividend, right? So Rick Rule made the same point about how he had seen some stocks that he had invested $10,000 turning into $100,000 by the height of the 1980s. Egon made the same point by looking at dividend, that the same dollar amount invested had turned into dividend cash flow. Now, why is that occurring? It's important to understand, because what is happening is that it's the dividend payment of the producers that are also rebuilding the monetary system, because gold is money, silver's money. Now, when it comes to silver, we have that substitution effect that we're starting to see, because people are figuring out, those that go to Costco and can only buy at Costco their physical gold and silver are realizing, wait a minute, for $3,300, for actually $3,700 US, I can buy 1 ounce of gold or almost 100 ounces of silver. So they're buying more silver, silver selling out quicker. So the substitution's already taken place. So everything is playing out. The question is, where are we going down with this? I think we're just getting going. And, it's about finding good quality assets that we can ride along the way going forward. And as investors, that's how we're going to save ourselves. And to some extent, that's my life replaying, because it's the same monetary adjustment that occurs in Latin America, in Chile, in Argentina, Venezuela last. But this time it's global. The whole system is rebuilding. So all I'm doing is taking all of my experience, both professionally and through history, and allowing the system to rebuild around me. And one of the things, as well as Canadians, that we clearly have to understand, our government doesn't have any gold in backing our currency. So we're in even bigger trouble. One of the things I do advise my Canadian clients especially is an understanding that they have to build their own gold standard to protect their savings. And that's so important, because at first, everybody was kind of a little bit scared in the last 3 years. We're not moving anywhere. They were seeing gold and silver run up in price, but the companies weren't yet producing the yield. But now all of a sudden, the winds are our backs and everything's moving properly. So it's a beautiful feeling now that we've done the hard work. And by the way, one last point, and then I'm going to just drop it. Think about how hard it's going to be for somebody with $5 million and zero allocation because their advisor has just been parking assets in the sector. I'm advising 30% because 20% is the bare minimum you need to protect your savings. Another 10% to benefit and be able to speculate. But if you have a $5 million account, 30% of $5 million is $1.5 million bucks. Most advisors are not going to have the cojones to actually put that money to work or the knowledge on how to put it to work, because they're going to go buy some ETF or something that's paper-based. The challenges going forward is going to be the future contracts that are creating all of these products that are all over the place. Those are IOUs by financial institutions that might be in trouble. So how do you properly position a portfolio in the assets, in the stocks, stock picking, which again is another part of the cycle rebuilding, because don't forget that the 70s and 90s, we had to learn how to stock pick again. That's where Merrill Lynch surges. That's where Fidelity, who was the white hair guy at Fidelity? Peter Lynch.
Peter Lynch, yeah.
Peter Lynch. Remember? It's all about stock picking, because through that inflationary period, not everything works. You have to become a stock picker again. And that's what's missing in my field. That one of the problems that we have right now with the advisory is that they've been easily just parking assets in pools that have moved very well, but that wind is drying. And now you have to learn how to stock pick again.
Yeah. Jaime, I have one question for you. And then Dan, I want to hear from you about First Mining Gold. But Jaime, you mentioned something earlier, the word unobtainium, as you referred to gold and silver. And I want to get your opinion on this. When I look at the fact that 1% of the world's financial assets are invested into precious metals right now, and I think that like we haven't even begun to really see a material move of people coming into the sector, that when there is a move, like going from 1% to, let's say, 5%, is that even possible? Like, is there enough gold and silver out there that's available? Like that would be like a 5x move in terms of assets. I mean, I guess price fixes everything, but it just feels like we're in a very, and you guys both mentioned this, like we're early. I think all three of us were early into this sector, but that we could very well find ourselves in a very advantageous situation in the future.
I think it's important to understand that it's the exponential effect of how prices will rise that is important. Because right now we have silver at 36 bucks. It cut through butter at 35. We only saw it for one day, and if you got lucky, you could have picked it up at 35. But how quickly do the prices accelerate going up is going to be the question, right? I know that these things always accelerate as people finally wake up, and I think it's up to each of us to make that decision on how do we cut quickly and how to shape up. That's one of the expertises of my practice, that I'm one of the few that has been working in the sector for such a long time that I know how to cut very quickly and how to get people properly positioned. But you're going to have to take a bit of a blind faith step into the abyss and just jump into it, right? Because but that abyss is getting further and further away from investors, right? So unobtainium, in the fact that the price will always be there. It's whether your money will be able to buy you the level of insurance that you actually need is the question, right? Be it through the producers, be it through physical silver, or being through physical gold. Now, I do advise that you got to have a little bit of each within your savings, right? How to position yourself is important, because there's a lot of minefield. It's a massive minefield when you look at how a lot of the products are being structured. And I think that's another hot potato that we haven't even got to yet, because things haven't started blowing up. But you do see it, when you look at some of the derivative books of some of these banks, they have way more derivatives than the asset base that's backing it. 2 quadrillion is a lot of money. $1 trillion is a lot of money. It's funny, when Elon Musk stepped down, I kind of made a point of saying, well, maybe he figured out that what's the point of saving $1 billion here, $1 billion there, when interest rate expense is growing at $1 trillion a clip. Well, $1 billion and $1 trillion are a big difference. And don't forget that in 2008, we weren't even talking trillions. In 2008, the issues were billion based. Now we're talking trillions, right? That's a lot of money.
Jaime, the rescue in 2008, the unprecedented pumping of liquidity into the system at the end of what was almost a systemic collapse of the U.S. market, was $1.2 trillion. And that was unheard of. That was unprecedented. And now 1.2 trillion is like the run rate deficit for the year if we're cutting back.
Daily. What are you talking about? It's daily.
Hold
on a second.
Yeah, you're being too kind, Dan.
And another important point of that is that 1.2 went through banks around the world.
Yeah.
This time around, is Trump even going to allow any bailout of international banks? Right? I think this time around, everybody has to run for it. Is running for the hills and worrying about themselves because this is too big, right? And I think that's what clients have to wake up and realize that, hey, it's time to start thinking for yourself and how do you protect yourself?
Interesting. You mentioned being a stock picker earlier, Jaime, that we're moving into this environment where that's going to become more important. And, you know, kind of given everything we've talked about, what seems like a very bright future for the prices of precious metals. I'm wondering, Dan, I'm a stockholder in your company, First Mining Gold. Your company has 2 big multi-million ounce projects and a third million ounce project in Canada. Where do you see us right now in terms of, let's say, if we look at development stage companies, are we very early? It feels to me that we're still very early. And when I hear Jaime talking about the yellow brick road, you know, I think there's a lot of people who are starting to focus on the metals themselves. But it feels like there's even potentially more to gain from some of the junior and development stage companies. Any commentary on that you can share with us?
Yeah, absolutely. I mean, from our perspective, look at it in a couple of different ways. Number one, in the industry, you just need to understand that the producers, as Jaime has said, you know, on these high prices are generating record levels of free cash flow. They're paying out record levels of dividends that if you believe the gold price is going higher, that is going to continue. And so, you know, a lot of those you've seen 2, 3, 4x return in some of the producers already. There's a lot of developers, though. So to take a step back, most of those producers have not added to their productive capacity in recent memory. And a lot of that is, you know, they sort of shut down exploration budgets in 2011, 2012, really lost the capability to do meaningful greenfields exploration because they always had this, you know, these set of companies, junior exploration companies, that they didn't have to fund the real risk capital. And the industry wisdom was that, you know, the exploration sector will spend $100 and 98% of that will be wasted. And so if we have to pay 10x on the $2 that finds something, then, you know, we're better off. The reality is it's just, that's not working. You're starting to see, and I think you're going to start see more of panic amongst producers on reserve declines. So they've been able to offset that, recognizing that producers can drop their cutoff grades at higher gold prices and magically just show more gold that's there. I mean, the reality is more gold becomes economic as the price gets higher inside an existing deposit for a while. But if you don't find more and the deposit's not growing, and like mine shut down, right, because you run out of ore geologically, that's where I think we're starting to see some of that. It's not quite panic yet, but a real recognition that there's a bunch of 3 and 4 asset gold mining companies that in 5 to 7 years are maybe going to have one asset that's still producing because they're just not able to. You can't just flip a switch and immediately, you know, grow through exploration. So what that means is there's been this long suffering cohort, and I'd put First Mining in that camp, of companies that have advanced these development projects in really difficult times when they haven't had a lot of access to capital. And if you've been able to move these projects forward in that time, well, we're coming to a point where, let's say there's, you know, 20 companies that need to show reserve and resource growth. They all, you know, they all want to be putting that money into tier 1 jurisdictions. The number of tier 1 jurisdictions is shrinking every day. You know, not to kind of pile on our friends in Ecuador, but I know it'll be a fun one for Jaime, who follows a lot of things in South America reasonably closely. But this time it was totally different with Ecuador, right? Like it's, they built Fruta del Norte, total world-class mine. There's lots of good exploration development going on in Ecuador. Well, lo and behold, there's now a new tax that's come in that's going to be, I think, pretty punitive, particularly to the exploration and development sector there. So they all want to find great assets in tier 1 jurisdictions. And, that's something where we're seeing a lot more traction these days, in large part because and it's a very small group of us and others who've been able to move these projects forward in tough times. But we're now sitting at a time, I think, if we're not at the point where the industry needs them the most today, I think that point is absolutely in sight. And so what does that translate into? It translates into valuation of companies like ours, where, you could have bought First Mining Gold at $7 an ounce 2 months ago. Today, it's 10 or $11 an ounce. It's still a long way to go to $100 an ounce, which is where these development projects should trade. So, the flip side of that is, though, you've probably, missed out on the first, maybe the first doubling of it almost. Doesn't mean that there's not another 9x coming off that initial one. So if it goes up 5x from here, it still looks like it's a pretty, a pretty good bet.
Can I add to this, actually, because you made some really good points? First of all,
sure.
$11 an ounce. When I look at developers, when building a portfolio, and I've been started building my portfolios in 2015 when I was at Scotiabank. That's when I structured the portfolios that I manage now. But I've been investing in precious metals. Man, I can remember Bre-X back at Burns Fry, and that ran up at Arequipa and the companies that took us to that top of the market. Now, when I look at a developer, I look at buying reserves on the ground, knowing that eventually they will get taken out. Actually, in 2015, when I set up my portfolio, I actually added Detour Lake because I had bought Detour Lake a couple of years prior before they drained the lake, which I find very similar to what you guys are doing, where you're at that stage where prior to draining the lake, which eventually will have to be done or diverted. Now, why is that important? Because it's the $11 an ounce. Don't forget that at the height of the cycle in 2011, while I was there, I got taken out of a company called Trelawney at about $150 an ounce gold on the ground. That's how high we went. And that was at $1,900 gold. I don't think we have even seen where we're going this time. So when I look at something like First Mining or any development company, you got to think of building a portfolio. First of all, you got to look at your senior miners with a dividend. You mentioned Fruta del Norte. Here's a great example of something that I've invested all along, because I actually bought it as Aurelian around 2008. Got out of it when Kinross paid $1 billion for the asset. That's when I said, okay, I'm out of this thing, because I knew that, Kinross, Pan American, we just bought MAG. I don't want to own those companies. To me, they're fat management companies, kind of like Barrick, Goldcorp. And I managed money for Barrick, actually, along the way. I managed their stock option plan. But I don't like the management. But they're going to fly at $3,000, $4,000, $5,000 gold anyways. It'd be like putting lipstick. However, with Aurelian, I got out when Kinross bought it out. And then when the Lundins came back in, I jumped back in. So I've been in it ever since. And thanks to that, they also bought into Filo, which I also own a couple of exploration plays around that have done very well. But First Mining, it kind of blends between the two, because they're in the process of building a mine. And there's a lot of very good quality assets out there of reserves on the ground at ridiculous prices. And within the portfolio, I would want the producers first, the big boys, then the little boys, between silver and gold, right? Because that's where value is. But then you also want that section of developers within the portfolio. Something about a company like First Mining for Canadian investors, and a lot of other ones, is that when companies like that issue flow through shares, which if you're lucky enough to be able to get some, it's a perfect investment because you're buying them and then just holding it within the portfolio. I love being able to acquire those and get the tax benefit as I wait for prices to come back. But $11, I got to tell you, from following this sector since about 1997 on, is ridiculous. We're still buying assets. You're buying gold on the ground at a crazy number. Same thing with silver on the ground. And that's why the developers make sense within a portfolio. How do you position them? What percentage? There, you should talk to an advisor in terms of the percentage. But I think we have a long way to go because silver reserves on the ground really shows how myopic and how the money hasn't even started coming in at all. You know, let's get over $100 an ounce gold on the ground, which is the number in 2011. Right now, 11 is plenty of upside
at half the share price, right?
That's and what were the reserves? What were the reserves you guys had? When did you guys start down that path? Like how have the reserves exponentially increased through this period? Right?
Yeah. No, we've been, lucky to acquire those at very low prices when a lot of that work's already been done. So a bit of a different risk reward profile. But no, it's, I think we're pretty happy with kind of where we are and very happy with the support that we've had from our shareholders in some really tough times, to be able to continue to do the work so that when you get to better times, you have a project that's now, one of the most advanced with our final environmental assessment submitted in November and, targeting that EA decision at the end of 2025. So, $10 an ounce, I can understand it if those major milestones are still 15 years away. And that's the reality of an early stage discovery is you got a long runway ahead of you. But I think if you've been able to kind of claw your way through this very protracted downturn in the cycle, your time to wait's just not that long anymore. And so, I think it just means you're going to have a much quicker opportunity to see that re-rating come in.
One other thing that I wanted to make that I just remember, I made the note because you mentioned Ecuador and the tax. Listen, the Canadian government is going to put a tax on profits along the way. Everybody's going to tax. The big risk here is expropriation. Will they expropriate it? Well, first of all, people have to own it to be expropriated. So I don't think expropriation is in the cards because nobody owns it. Everybody thinks it's still a pet rock or a barbarous relic. It's just like no time yet. However, taxes are part of the game. My thing is that when I advise clients, I say, okay, make sure you shelter as much in the TFSA, right? The tax-free savings account that we have in Canada. Not necessarily the RSPs, because the RSPs, you're going to get taxed on the way out. So I'd rather have it invested outside. So part of taxes is part of the game, just like being Latin America. That's LATAM experience at its best. But be aware that I'd rather get taxed when I buy an asset at $100 an ounce and hold it and be taxed at $3,000 an ounce on that profit from that point forward, but be able to benefit. That's why I've been building my positions, but I'm fully aware that, yes, eventually the government's going to come and want its share. Because you know what? Even people don't understand yet that what to me is the biggest tax is the tax they put on our wages, right? Your labor is being taxed and being devalued daily through inflation. That's a stealth tax. So to figure out that part and be able to hedge your portfolio to fully protect yourself from everything, I think it's important, but that's all part of the geopolitical, all of the factors of risk that I go through when assessing and how to position money.
Excellent. Guys, this has been great. I want to thank both of you for joining me. Is there anything I forgot to ask either of you that you want to point out before we bid farewell?
Just don't ask for gold targets. Much higher.
Well, what I am going to do is share your respective websites. Hold on, I'm going to pull up First Mining Gold here. If people want to learn more about the company, firstmininggold.com. You can learn all about the spring pole and Du Parquet projects. And there's another project named Cameron that also has, Dan, correct me if I'm wrong, but about 1 million ounces of gold in the ground.
Correct.
And Jaime, let's see if I can pull up your profile here as well. You should be on the screen. Yep, there's a good picture of Jaime with Harbourfront Wealth Management. You can learn all about him there. Didn't have time to ask him about his sailing analogy, but maybe next time, Jaime, you can tell us.
And there's an easier email now. We've set up Jaime, as in Jaime, Jaime, at jcwealth.ca. Much easier than that long.
Oh. And guys, we almost forgot one of the most important things. If you want to learn more about First Mining Gold, you can reach out to their Director of Investor Relations, Mr. Paul Morris, Paul at firstmininggold.com. I think
Paul. Yep.
Call Paul. Yeah, call Paul. I think Paul, all three of us can agree, is a great guy.
He is.
And loves to hear from him.
Musician.
That's right.
Indeed.
Oh man, well, this has been great. I feel like I'm walking down the yellow brick road now. Jaime,
wearing silver slippers.
Silver. I know.
Silver slippers.
Yeah, a lot of people don't know that whole movie is kind of based off precious metals and the.
It is. It's an allegory for the banking crisis of the late 1800s.
Yeah.
So the wizard were the bankers. The yellow brick road, the gold standard.
Yeah.
Dorothy Slipper were silver, not red in the allegory in the book.
Mm-hmm.
The scarecrow is agriculture, the tin man is industry, and the lion is banking, but having been usurped by the wizard.
Yeah. Well, we're gonna travel down this yellow brick road together. Hopefully, all three of us will get together again sometime here in the next 2-3 months. It's been great, and thank you guys, and we'll see you next time.
That's great. Thanks, Ron.
Thanks for having me.